In this presentation, I introduce the first chapter of the book, Actuarial Foundations for Life and Health Insurance, devoted to insurance on a single life. This is the natural starting point for life and health insurance mathematics because it is the simplest situation in which payments depend on the uncertain lifetime of an individual. The chapter is not only a review of traditional life insurance products, its main purpose is to formulate these products in a stochastic process framework. This viewpoint will be essential later when we move from a single transition, from alive to deceased, to richer models with several states, several possible causes of exit, or several insured lives. The central idea is that premiums, benefits, reserves, and mortality estimation can all be organized around the same probabilistic description of survival and death. The presentation is organized in 4 parts. I first explain the two-state model used to represent the lifetime of one insured individual. I then introduce the force of mortality, survival, and death probabilities, and the counting process representation of death occurrence. The third part moves to actuarial valuation, pure premiums, expected present values, mathematical reserves, and Thiele's equation. The last part turns to the statistical estimation of mortality rates, starting from exposure and observed deaths, and then using smoothing, Poisson regression, and relational models. The aim is to show that the same object, the mortality intensity, connects the probabilistic, actuarial, and statistical dimensions of single life insurance. Single life insurance is the fundamental building block of the chapter because it is the simplest setting in which cash flows depend on survival or death. A contract of this type may cover death, survival, or a combination of both, and the insurer manages the uncertainty by pooling many similar risks. The insured lifetime is represented by a two-state stochastic process, whose states are alive and deceased. This representation may look more formal than classical actuarial notation, but it makes the logic of the contract very transparent. Payments are triggered by the path, followed by the process. The central actuarial object is the force of mortality. It is the instantaneous rate at which a life currently alive is expected to die, and it connects survival probabilities, death probabilities, counting processes, pricing formulas, and reserve dynamics. The chapter also explains how this quantity can be estimated in practice. The actuary observes deaths and exposure to risk, constructs crude mortality rates, and then smooths them because raw estimates are too irregular for pricing and reserving. The statistical tools include Poisson regression, Loess, cubic splines, and relational models, especially useful for small portfolios. We now enter the first part of the presentation, which is the probabilistic representation of single life insurance. The key modeling decision is to describe the insured lifetime through a process that can occupy only 2 states. This is the simplest possible multi-state model, but it already contains all the basic actuarial mechanisms. While the insured is alive, premiums may be collected and annuity-type benefits may be paid. Once death occurs, the process moves to the deceased state and remains there. The transition is irreversible. This two-state structure is deliberately simple because it prepares the language used later in the book for contracts with several exits, for instance, death from different causes, disability, surrender, or joint life contracts. The figure represents the whole probabilistic structure of a classical single life contract. The insured starts in the alive state at policy inception. The only possible transition is from alive to deceased, and this transition occurs with an age-dependent intensity called the force of mortality. The arrow should be read as the possible occurrence of death during the coverage period. If the insured remains alive, premiums may continue to be paid and survival contingent benefits may be due. If the transition occurs, a death benefit may be paid, depending on the contract. The strength of this figure is that it separates the demographic mechanism from the financial cash flows. The process describes when the insured is alive or dead, while the contract specifies which payments are attached to each part of the trajectory. This is why the same figure can represent term insurance, whole life insurance, pure endowments, or life annuities after changing only the benefit and premium functions. It also makes clear why single life insurance is the prototype for multi-state actuarial models. Later, the state space will simply be enriched. Consider an individual aged X at the beginning of the contract. Time zero is policy inception, and the stochastic process records the insured status at each later duration. At duration t, the attained age is X plus t. If the process is in the alive state, the insured has survived to that age. If it is in the deceased state, death has already occurred before that age. This modeling choice is directly linked to cash flow valuation. The insurer and the policyholder do not exchange fixed deterministic payments. They exchange payments whose timing and sometimes amount depend on the path of the process. In term insurance, for example, the death benefit is paid only if the transition to the deceased state occurs before the end of the term. Premiums are usually paid only while the insured remains alive. This explains why actuarial valuation must combine financial discounting with survival probabilities. The process-based view also prepares a natural extension to richer contracts. If death can occur from several causes, or if disability and recovery have to be modeled, the state space is expanded, but the same logic remains. The displayed notation gives the standard actuarial probabilities associated with the two-state process. The survival probability over duration t is the probability that an individual aged X at inception is still alive at age X plus t. The death probability over the same duration is the complementary probability that death has occurred before that attained age. These two probabilities are therefore linked by a simple complementarity relation because in the two-state model, the insured must be either alive or deceased. The same quantities can also be expressed through the remaining lifetime random variable. This is the future time spent in the alive state before the transition to death. Survival over t years means that the remaining lifetime is greater than t, whereas death before age X plus t means that the remaining lifetime is at most t. This connection between the process formulation and the lifetime formulation is important. It shows that the chapter does not abandon traditional actuarial notation, but embeds it in a broader stochastic process framework. For 1-year probabilities, the usual shorter notation is recovered. The displayed expression corresponds to equation 1.1 in the chapter. It defines the force of mortality at attained age X plus t as the limiting death rate over a very short future interval, conditional on being alive at the beginning of that interval. This is not a probability. A probability over a very short interval is approximately the force of mortality multiplied by the length of the interval. The force of mortality is therefore measured per unit of time, and it captures the local intensity of death. Its interpretation is similar to an instantaneous hazard rate in survival analysis. When the value is high, an individual alive at that age faces a high immediate risk of death. When it is low, the local risk is small. This local view is particularly useful in continuous time because it allows survival probabilities to be reconstructed by accumulating mortality intensity over time. It will also enter pricing and reserving formulas directly, since death benefits are weighted by the probability density of death at each possible future time. The two displayed relations correspond to property 1.3.2 in the chapter. They show how survival and death probabilities are obtained from the force of mortality. The death probability before duration t can be understood by considering each possible future death time. To die around a future duration, the insured must first survive up to that duration and then die with the local intensity prevailing at the corresponding attained age. Integrating this contribution over all possible death times gives the death probability. The survival probability has an even more compact form. It is the exponential of minus the accumulated mortality intensity over the interval. This accumulated intensity is called the cumulative hazard. The result is one of the most important links in the chapter. It shows that once the force of mortality is known for all attained ages, the full survival curve is determined. Conversely, if a survival curve is available and sufficiently regular, the force of mortality can be recovered from it. This is the bridge between demographic modeling and actuarial valuation. In practice, life insurance data are often observed by integer ages. The actuary knows how many individuals were exposed between age X and age X plus 1 and how many deaths occurred during that interval. This annual aggregation is not perfectly aligned with a continuous time model. The chapter therefore adopts a working assumption that is very convenient for statistical analysis. Within each completed year of age, the force of mortality is constant. Mortality may still vary from one age to the next, but it does not vary inside the annual interval. Under this assumption, the annual survival probability and the annual death probability determine the constant annual force of mortality. Survival over a fraction of a year can then be reconstructed easily by raising the annual survival probability to the corresponding fraction of the year. This assumption is less classical than assuming deaths are uniformly distributed over the year, but it is very well suited to likelihood calculations and exposure-based mortality estimation. It connects continuous time formulas with the way mortality tables are usually observed and used. The survival status can also be described by a counting process. This process is equal to 0 before death and jumps to 1 when death occurs. After the jump, it remains at 1. This is a natural representation because death is a single non-recurrent event. The stochastic intensity of this counting process is the instantaneous jump rate, conditional on the information available just before the time considered. It is equal to the force of mortality multiplied by an exposure indicator. The exposure indicator is 1 as long as the insured is alive immediately before the time considered and 0 after death. This means that the individual can experience the jump only once. Before death, the instantaneous jump rate is the force of mortality at the attained age. After death, the intensity is 0 because the person is no longer exposed to the risk of dying. This formulation is important because it brings single life insurance into the general framework of counting processes, which is widely used for survival data, event history analysis, and multi-state actuarial models. The displayed identities introduce the compensator and the martingale part of the death counting process. The compensator is the accumulated predictable intensity up to time t. Because the individual is exposed only before death, the compensator accumulates the force of mortality only until the minimum between time t and the remaining lifetime. It can therefore be written as the cumulative hazard stopped at death. Subtracting this predictable component from the observed counting process gives a martingale. This is the Dubmeier decomposition in the particular case of a single death process. Its actuarial interpretation is useful. The compensator represents what can be predicted from the mortality intensity, whereas the martingale captures the random timing of death beyond what the intensity already explains. In differential form, the increment of the death process is split into a predictable intensity part and an innovation part. This decomposition will become especially useful when studying surplus processes because it provides a rigorous way to separate expected cash flow evolution from random deviations. We now move from the demographic model to actuarial valuation. The same stochastic process will be used to value the payments promised by the policyholder and the insurer. The main idea is to combine two effects. Financial discounting accounts for the time value of money, while survival and mortality probabilities account for the contingency of payments. Premiums, annuity benefits, and death benefits are not treated as isolated formulas. They are all expressed as expected present values of cash flow functions observed along the path of the survival process. This leads naturally to pure premium calculation, mathematical reserves, and Thiele's equation. Pure premium calculation is based on the principle of equivalence. The expected present value of the policyholder's payments must equal the expected present value of the insurer's benefits. This does not mean that the insurer has no risk on each individual contract. It means that for a large, homogeneous portfolio of independent lives, the law of large numbers makes expectation a meaningful pricing basis. The chapter distinguishes this pure premium calculation from the later addition of loadings for acquisition and management expenses. Two technical bases are needed. The first is the discount function, or equivalently, the force of interest, which converts future payments into values at policy inception. The second is the force of mortality, which determines the probability that the insured will still be alive or will die at each future time. The displayed discounting formula says that the value today of 1 unit paid at a future time is obtained by accumulating the instantaneous interest rate over the interval and applying exponential discounting. This financial component is then combined with the demographic component. The displayed valuation formula describes the expected present value of premiums paid up to time t. The function denoted by capital Pi in the slide represents the cumulative premium schedule for a policyholder who is still alive. It may describe a single premium at inception, periodic premiums paid in advance, or continuous premiums paid at a rate. In the actual contract, premiums stop after death. This is why the integrand contains an indicator of being alive immediately before the payment time. Taking expectation replaces this random indicator by the survival probability to that time. As a result, the expected present value of premiums is obtained by discounting each scheduled premium payment and multiplying it by the probability that the insured is alive when the payment is due. The last line of the displayed formula gives an elegant interpretation. The premium schedule is discounted at an augmented rate, combining the force of interest and the force of mortality. Financial discounting reduces value because money is paid in the future, and mortality reduces value because premiums may cease before they are paid. The insurer's benefits are decomposed into two types of payments. The function B describes annuity-type benefits paid while the insured is alive. These benefits may be continuous or paid periodically. The function C describes the death benefit paid if death occurs at a particular time. The displayed formula gives the expected present value of both components. For survival contingent benefits, each payment is multiplied by the probability that the insured is alive at the corresponding date and then discounted. For death benefits, each possible death time contributes a discounted amount equal to the benefit at that time, weighted by the probability density of death at that time. This density is expressed through survival up to that time and the force of mortality at the corresponding age. The formula therefore makes explicit the two possible modes of payment in single life insurance: payments conditional on remaining alive and payments triggered by death. Many standard products are obtained by specifying the functions B and C appropriately. This unified notation avoids deriving separate pricing principles for each product. The mathematical reserve at time t is the insurer's net commitment, conditional on the insured still being alive at that time. It is the expected present value of future benefits minus the expected present value of future premiums still to be paid. The displayed reserve formula expresses this idea directly. It looks forward from time t to the end of the contract and values the remaining survival contingent benefits, death benefits and premiums using conditional survival probabilities from age x plus t. If the insured has already died, the reserve is 0. Thiele's equation then describes the local evolution of the reserve. The equation says that the reserve increases with interest earned on the existing reserve and with premiums received. It is also affected by mortality. When death occurs, the insurer pays the death benefit, but also releases the reserve that had been held for that policy. Finally, the reserve decreases because annuity-type benefits are paid. This equation is a compact local balance sheet of the contract and is one of the central actuarial tools for reserving. The general valuation framework covers the main classical products. A pure endowment pays 1 unit at a fixed maturity if the insured is alive at that date. Its value is therefore the financial discount factor to maturity multiplied by the survival probability to maturity. A life annuity pays a sequence of amounts as long as the annuitant remains alive. Its value is obtained by summing discounted payments weighted by the probability of survival to each payment date. A whole life insurance pays 1 unit at death whenever death occurs before the limiting age. Its value is obtained by integrating over all possible death times, using survival to the death time, the force of mortality at that time, and the discount factor. Term insurance is the same idea but restricted to death during a fixed coverage period. An endowment insurance combines a term insurance component and a pure endowment component. The benefit is paid either at death before maturity or at maturity if the insured survives. The formulas on the slide are therefore not isolated cases. They are specializations of the same general cash flow model. The final part of the presentation explains how the force of mortality is estimated from data. Actuarial valuation requires a mortality basis, and this basis cannot be assumed to be known. The chapter starts from exposure to risk and observed deaths, then explains why crude mortality estimates must be adjusted. It then presents parametric and non-parametric smoothing tools with particular emphasis on Poisson regression and relational models. This statistical part is important because the mortality table used for pricing and reserving has a direct impact on premiums, reserves, and the financial balance of the contract. Exposure to risk measures the amount of time lived by insured individuals in a given age interval. Between ages X and X plus 1, it is the total person time contributed by the members of the cohort. Someone who survives the full year contributes 1 year of exposure. Someone who dies during the year contributes only the fraction of the year lived before death. The number of deaths at that age is then related to the exposure. Under the assumption that the force of mortality is constant within the year of age, the likelihood leads to a simple maximum likelihood estimator. The crude mortality rate is the number of observed deaths divided by the exposure. This estimator has a very intuitive interpretation. It is a death frequency per unit of exposed time. However, crude estimates can fluctuate substantially, especially at ages or in portfolios where exposure is low. These fluctuations are statistical noise, not necessarily real changes in mortality. For pricing and reserving, the actuary needs a stable mortality curve. This is why smoothing and regression methods are introduced after the crude estimation step. The figure illustrates the adjustment of mortality rates for Belgian men in individual life insurance. The vertical axis is on a logarithmic scale, which is natural because adult mortality often grows approximately exponentially with age over a large range. The irregular line represents the crude estimates obtained from observed deaths and exposure. The smoother line represents the adjusted mortality rates obtained using a nonlinear Poisson regression model, with the age effect estimated by a smoothing method. The chapter explains why Poisson modeling is convenient here. Conditionally on exposure, the number of deaths at each age can be approximated by a Poisson distribution, whose mean is exposure multiplied by the force of mortality. This approximation leads to the same crude estimator as the likelihood based on individual contributions, but it also allows the actuary to use regression techniques. The purpose of smoothing is not to remove information. It is to replace random age-by-age fluctuations by a coherent mortality curve that can be used for actuarial calculations. The adjusted line captures the systematic age pattern while attenuating local noise. This figure concerns the impact of portfolio size on mortality estimation. It displays exposure profiles for portfolios with different total exposures while preserving the age structure of the Belgian individual life insurance market portfolio for men. The key message is that the amount of available exposure strongly affects the reliability of experienced mortality estimates. When the portfolio is large, the observed deaths contain enough information for mortality to be smoothed mainly as a function of age. When the portfolio is small or medium-sized, crude estimates are much noisier, and it becomes useful to borrow information from a reference mortality table. This is the purpose of relational models. They link the mortality of the portfolio under study to the mortality of another population for which reliable rates are available. In the numerical illustration, portfolios with 10,000 and 50,000 policy years selected reference rates from the general population, whereas the 100,000 policy year portfolio selected age as the explanatory variable. The regulatory MR table was not retained because its Maycomb shape did not match the market mortality pattern. We now close the presentation by returning to the main message of the chapter. Single life insurance may look elementary, but it already contains the central ingredients of life and health insurance mathematics: stochastic modeling of the insured status, survival and death probabilities, mortality intensity, present value calculations, reserves, and statistical estimation. The value of the chapter is to bring these ingredients into a single coherent framework. This framework is deliberately chosen so that it can be generalized in later chapters, rather than being limited to traditional single life formulas. The chapter shows that single life insurance can be described coherently by a two-state stochastic process. This is the simplest possible process-based model, but it is powerful enough to represent the dependence of premiums and benefits on survival or death. The force of mortality is the common thread running through the whole chapter. It determines survival probabilities, appears as the intensity of the counting process, enters the pricing of death benefits, and underlies the construction and smoothing of mortality tables. The principle of equivalence provides the pure premium calculation rule by equating expected present values. Thiel's equation then provides the dynamic reserve equation, explaining how the reserve evolves through interest, premiums, mortality, death benefits, and annuity payments. The chapter also shows that actuarial formulas depend on statistical estimation because the mortality basis must be inferred from exposure and deaths. The final transition is important. The two-state model is not the end of the theory. It is the prototype. Once additional causes of death, disability, surrender, selection effects, or several insured lives are introduced, the same process-based logic naturally extends to multi-state models.